Hey traders, welcome to Charts and Coffee. Happy Wednesday, everybody. Hope everyone is having a good morning. Today's the day. It's the day that we've been told about for weeks and weeks, and we're going to get maybe a little bit of clarity on what's happening with the tariff deadline. Here's the main thing that I will step back and say. Everyone calculates the market, their risk, reward, their opportunity based on a certain set of tools. And if you're tuning into this show, you're looking at price action, you're looking at volume, volatility, and time. Those are the four factors of the market. And frankly, they're the same four for everybody. We're all working with the same calendar and clock. We're all working with the same open, high, low, close. Volume is volume, whether you're looking at time-based or price-based volume. And depending on your look back for volatility, these are things that are measured and pretty much are in a level playing field. What's not a level playing field? Things like flow, things like news. Those are things that I'm not going to necessarily use because I'm going to rely on the charts to make my decisions. Call it chartist, call it technician, whatever you want to call it. Bottom line is a day like today is going to be calculated through sort of the prism of those four factors. And here's what I know, right? I don't know necessarily how the reaction, the tariffs are going to be. Guess what? Regardless of what they say on television, neither do they. So what we have is a low that we punched down to on Thursday, March 13. That low there at 55.09 and a quarter is on the current front month of the futures contract. Now think about this for a moment. If I'm looking at SPY, it's an ETF of the S&P. If I'm looking at SPX, it's the cash, right? It's the now view. What I like to do and what the market does, right? Think about what everyone's been doing for 6 weeks, easily since mid-February. We're projecting forward what we think is going to happen. The market is a forward-looking, sort of fortune-telling, future-telling machine. We don't know the future, and yet that's sort of the game. Well, why not look at the thing, in this case, the S&P June contract that is calculating based on the end of this contract being June. So take the S&P out of it and let's talk about corn. All right, if you are a farmer and you sold a future contract, let's just use June to keep apples and apples. Let's say you were selling a June contract to someone who needed 5,000 bushels of corn. That's one contract of corn futures. And the promise is you're going to deliver that in the future, in June. So you're not necessarily pricing corn the way that it is today because you're not delivering this thing until the future. So you're calculating in uncertainties, storage, whatever it may be, what maybe seasonal prices tend to be in June. You're calculating demand in June, right? That's what, say, the S&P 500 June contract or even the bonds June contract is doing. It's not today. It's thinking about what's happening and then projecting it forward. And the more we can keep that mindset, the better off we're going to be. What we already know or think we know or are rumored to know, whatever we suppose could be true, is all being priced in now, which is why all of us are very comfortable with the saying, buy the rumor, sell the news. What's the rumor? Well, we know we're going to get this tariff narrative. We know certain things based on the previous 6 weeks on what those are likely to be, what wiggle room there is around it, etc. The tone between the two countries. We know a little bit of that, right? We can observe, and that gets priced in. But as we get closer and closer to the actual event, we're going to finally get an answer on whether we guessed right. Now we've turned the paper in to the teacher, and we're going to see if our answers were right, right? That's kind of the way trading works. So right now, what we know is fear is not greater than, for example, looking at the Dow June contract, fear is not greater than the low that we punched down to on Thursday, March 13th. It's somewhere in the middle. Is it still fearful? The way that I look at price action and participation, yes, this is very much bearish chop, but it's no longer a downtrend. And in light of what we're expected to get today, I think it's at 4 p.m. Eastern, we don't have more fear than we had then. In fact, we've discounted or baked into the cake the fear based on what we think we know to be true. What happens with buy the rumor, sell the news, and I use Apple so often, we talked about this yesterday, is in anticipation of, a product release or a worldwide developers conference, Apple rallies into the event. And what does it do shortly after the new iPhone 412 is released? It sells off. Buy the rumor, sell the news. Well, the opposite can be true, and that's often termed a relief rally. So everything we thought we knew that was negative gets baked in, gets priced in. And then when we get the thing, we get the news, if it's not as bad as we thought, there's usually a sigh of relief rally. Now, let's take a look at the NASDAQ because it looks markedly different than the S&P and the Dow. The NASDAQ's far heavier than the S&P and Dow. So let's also, I try this as well. Let's not paint the entire market with one brush. In fact, the term the market, as much as we all say it, I'm guilty of that too, it's simply not true. There's no such thing as the market. There's indices, currencies, treasuries, energies, grains, softs, meats, right? There's all these things, metals that we look at. So there's no the market, although usually what we're referring to is, say, the S&P 500 and a curated group of stocks. But we have to separate out all of these things. The NASDAQ is very different in terms of its behavior in front of this event than compared to the S&P and the Dow. If there is somewhere that I'm a little bit more concerned looking at price action, where it's heavier, where as recently as the end of March, NAS didn't stay there, but it punched down to a lower low. You can see just by price action, I don't need to know the news. I don't need to know that people are scared. Frankly, I don't even need to look at the VIX, which doesn't measure the NASDAQ at all, but rather the S&P 500. Are we more scared than we were? Is there more fear than there was, say, taking a look at March 10? No, right? That's the way I'll look at this. I'll look at what I see, not what I think. I'm not going to try to outguess what is happening. I'm not going to say the current consensus and opinion is wrong. Who am I to say, right? There's an old saying, I'm not going to think that I know where the markets are going to go until I write a check and the bank bounces. In other words, I'm not moving the market, right, at all. So that brings us to the topic of what is moving the market. Well, obviously we know the news of tariffs, but let that take a step back, because for a lot of you, this is not your first rodeo in news that is supposedly going to be the beginning of the end. I love to bring this chart up for a little bit of reference. This goes all the way back to about the mid 80s. And you can see, actually, yep, there it is, 1986, all the way to that other event that was supposed to end everything, which was the Bank of Japan rate hikes. This is kind of a chart of the natural drift of what happens in equities. And yes, there are some significant pullbacks, no question about it. But overall, there's a general drift higher. And if the current chaos and noise and fear is too much, step out to take advantage, step out to a longer term time frame to take advantage of this. Call it investing, call it position trading, call it whatever you'd like. But this is really an approach that says, hey, do I have an ability to put in a trade and manage risk for the next minimum of 6 months? And then if I can make it through that sort of testing period, can I hang on to something for years? And this is where I step back and say, in an environment like this, where we're getting 10 and 20% pullbacks in the indices, in high concentration weighted sectors in the indices, and in important stocks that are weighted in the indices, when I think about those 10 and 20% pullbacks and fast forward 12 to 18 months, am I going to regret having bought some of these, call them dips if you'd like, right? Probably. History has taught me, 30 plus years has taught me, when Wall Street throws a sale, very few people come. And as much as people say, let's buy the dip, it takes very different commitment to your charts. It takes a very different commitment to time-tested processes to do it. Everyone talks about it. Very few people do it, right? So that's kind of where we are right now today. Let's take a bigger picture look at not just today, meaning the deadline for the tariff or Liberation Day, right? Let's step back and say we're going to get non-farm payroll on Friday. We're going to hear from Jerome Powell, who is really the macroeconomic driver of messaging and monetary policy, right? Where he's going to be speaking at 11:25 on Friday. We are expecting at least, let me show you here on the graph, we're expecting at least 2 more cuts. As of right now, right, knowing what we know, we haven't heard from Jerome, we don't have non-farm payroll, but knowing what we know right now, come December, there's a very high chance that we've seen 34% at least that we're going to see 3/4 point cuts. So when anyone's out there speculating on no cuts, it's not in the data. They're just talking some opinion that they have. And that is, for me, a step back from the process. Process is price, volume, volatility, time, and data, right? And Fed fund futures are the greatest way, the most powerful way to look at a concentrated amount of people who have actually put money on the line to make a bet on what the Federal Reserve is going to do at each meeting. I'm not saying that alone will rally the markets, but it's certainly a bullish sort of undercurrent, if you will. All right. First question coming up is Walmart. All right. Doug. Doug saying the 200. So Doug, there's 3 ways, I think, probably. Well, in my room, we look at the 200 via something called top tier dots. And it's a different coding that is mostly probably similar to a 200 period exponential moving average. But yes, I usually use a 200 EMA. You can use an SMA, but a simple moving average or an exponential weighted exponential moving average. The white dots are my 200, and we've come off those dots. And as far as what are my thoughts on Walmart, I can tell you actually what we did. There's no, to me, this session's really about talking my book. We have a long position in Walmart built from 85. And yes, it's not on the daily that I've done this. It's actually that longer term position trade type mentality, months to years. And we built that at 85 with a far longer term time horizon on Walmart. And again, time frame matters. Let me know what time frame you're looking at, gang, because it's as specific as the symbol itself. To look at a daily, to look at a weekly, to look at a 1 hour, all right? We want to be specific to the time frame. So my setup on Walmart is weekly. All right. Next up is Ian asked about my Pingala tool. That Pingala is purely a intraday tool, Ian. So I set up a pre-market zone that uses Fibonacci based on price action that happens before 9:30. No, I don't really look at it for swing trading. Yeah. And then as far as anchored VWAPs, no, the Pingala is a completely different thing. I mean, look, it's really a 50% retracement. That's all it is. So if you anchor a 50% retracement to the 1st of January, it's really not telling you much. You could. I don't have any data. I don't have months and months, if not years of testing before I say, yeah, try it. And the only way that something goes from things that I'm testing to things that I'm sharing is after a minimum of 6 months. And it's usually far greater than 12 months. I test it through multiple seasons of the market and say, hey, there's some veracity here. It's viable across multiple scenarios in trading. So no, I anchor a volume weighted average price to January 2 this year because that was the first trading day of the month. All right. As far as next up, PSX. Again, gang, it'd be great if you throw those time frames in there. Otherwise, I'll just presume it's the daily. All right. So in terms of PSX, would I look at long puts? I would not. I would not look at long puts. 2 things I'm looking at in terms of strength in different sectors. One is the commodities in terms of crude oil. It's still heavy, but it's trying to climb. And you can definitely see that the overall momentum in crude is bullish, but there's still a major obstacle right around $73 a barrel. The crude's far from out of the woods in terms of strength in the commodities, but commodity stocks, so in this case, oil stocks, oil and gas explorers, oil services, oil and gas explorers and energy have really started to take on a little bit more bullishness, and they are above those white dots. Crude oil is not, but Exxon, Chevron, XLE is. So I'm based on that price action, and then based also on relative performance. Let me show you here what that looks like. Bear with me here one moment. I'll show you what I'm looking at in terms of relative performance. All right, so I head on over to I'm going to look back 1 month. This is Koyfin, KOYFIN.com, and I'm looking at the market sectors here and a handful of industries. And you can see here that when I look at the lineup of the last month, how did sectors emerge from the month of March? Number 2 is XLE, right? And then you've got XOP up in there too. So I'm a little bit more bullish based on that normalized or relative performance. I would far prefer crude oil trading at or above 73, but oil stocks have already started to make that move. And you can see for the last month, those two sectors, XLE, energy, and XOP, oil and gas services, are positive. So I'm not really a big fan of that long put. Maybe if you want to be a little bit more nimble with something like that, and you're saying, Rob, yeah, but it's not quite super. Here we go. It's not quite super bullish yet, but there's still a little bit of bearishness. Maybe look at a 1 hour chart. Maybe look at a 1 hour chart of, say, PSX, and ask yourself, are there upside resistance levels that you would presume could hold and therefore be a level to trigger long puts, maybe just above 125. I can't say it's high on my list, but that could be something to look at if you're bearish and want to get long puts on PSX. But I'm going to go back to the group of stocks that generally are going to be moving like Phillips 66, and they're moving higher. So I'd rather find a long setup. All right, next up, Gregory asks about PAAS on the daily. All right, so let's take a look at PAAS on the daily. And if I take a peek at this, what are the things that are standing out to me? Gregory, we're above the anchored VWAP for the year. We're above the white dots, which is, for me, where the line in the sand is for more bullish sentiment versus bearish sentiment. Being above it is more bullish sentiment. I've got some interesting support by way of the automated support and resistance tools that are running on my charts. And that area around 25.25 is pretty darn interesting. Now, that's a price-only based level. So another thing we could do is jump on over to PASS on TradingView. So let me just really quickly here show you all. So on one hand, I've got all my tools running on Thinkorswim. One of the reasons that I like TradingView as an additional look is that I can use these this volume profile that's running along the right edge of the screen. And what I'd like to see, if I look at the action for 2025, so this year, where is volume weighting? And interestingly enough, while there's your point of control right there. I mean, you want an easy, hey, this is where participation's kicked in. This is where there's attention. Take a look at that level right there around 2472. I would treat that as probably the ideal scenario. And then probably secondarily, I look at this Darvis level here around 25.25. So those two levels would be levels I'd keep an eye on for PASS. All right, what about AFL on the daily? All right, so let's keep this going. Taking a look at AFL, AFLAC. I like this one because of KIE. So let's go back to this chart here. Great question. Take a peek. Look at what else is up in the top and positive. Yeah, so I like where you're looking. So what we have there is the insurance group of the KIE ETF, and AFLAC, AFL, is part of that. Now, higher highs are seldom going to be an opportunity for me, but trends are. We do have a trend as of yesterday. Well, actually, the trend confirmed on Friday, and then it continued on Monday, and it continued on Tuesday. Probably the best level, the nearest, most aggressive level that I would look at is somewhere between 110.80 and say 110.55. 110.80 to 110.55. So a slight pullback to that support level. I'm not ever going to be a buyer at higher highs, especially within the context of a trend. It can work better. There's no question about that, but I'm going to wait for some sort of pullback. If you want to be even more conservative, you can wait for a mean reversion pullback, and a really good level for that might be 107.80. All right, gang. So that's a wrap. Thanks as always for being here for Charts and Coffee. I'll see you tomorrow. Same time, same station. Be good to each other.